I am going to be telling you all the secrets to market structure. In this episode, I will go over things about market structure that I have not touched on before on my YouTube. In a previous episode inside the A to Z guide, we also went over market structure. So I think the basis, the bird's eye view of market structure, the way I view it is pretty clear. But now I want to define it even more. Because again, if you understand this is literally all you need. First, I wanted to go over NASDAQ, and afterwards we are going to go over a Forex pair as well. Please, on this episode, it is crucial to listen to everything I say and to take notes. Now let's start off with how do we view market structure again. So let's remind ourselves of the basics again. We only look at intermediate term highs and intermediate term lows and short term highs and short term lows. The way I view an intermediate term high, and this is the only way I view it, nothing else. I don't look at is it rebalancing a fair value gap, is it doing this? No. The only way I view an intermediate term high is when we have a high that is in the middle and is in between a short-term high that is lower to the left of it and lower to the right of it. So this, for example, right there is an intermediate term high. The same for an intermediate term low. An intermediate term low is when we have a low that is in the middle. It is in the middle of a short-term low that is higher to the right of it and a short-term low that is higher to the left of it. So this right there is an intermediate term low. And they are the outsiders. Intermediate term highs and intermediate term lows are always outsiders. What I mean by that is that this, for example, right there, this is also a short-term low. This is a short-term low, which makes this as well an intermediate term low. But if this intermediate term low has an intermediate term low just below it, very close to it, like this one, then you would take this one, not this one. It's the same with the intermediate term high when this, if we look at it from an objective standpoint, yes, this could be an intermediate term high, but this is your real intermediate term high. And if we want to look at it from an objective standpoint, that is exactly what we're going to go over. Because if we combine the time frames, then this is not an intermediate term high. But that is something we will go over in a few moments. First, we need to talk about the short-term highs and short-term lows now. So this is an intermediate term high. This is an intermediate term low. Listen very carefully. In between moving from this intermediate term high to that intermediate term low, short-term highs will form. No intermediate term high will form in that period. So when we move from that intermediate term high to that intermediate term low, in between this price action, there is no intermediate term high. Every high that's there is a short-term high. And a short-term high is defined by having, of course, a swing high. So that right there, let me zoom in a little bit. That right there is a short-term high. This right there is a short-term high. Now this, could that be an intermediate term high? No, it is not. Why isn't it an intermediate term high? An intermediate term high forms after we take an intermediate term low. So once we take this intermediate term low right there, which is the target when moving from that intermediate term high to that intermediate term low, if we then get a bigger retracement, this intermediate term high is the one that is protected. And now we can expect potentially, if it does want to have a bigger retracement, then it will likely respect that high. With respect, it means that yes, it can take the high, but it's respecting the high still. This is your last line of defense. If we disrespect that, so aka the fair value gap video that we went over, if we close above it, if the bullish fair value gaps are getting respected right there, then that is a sign that we are disrespecting that high. That is not supposed to happen. So once we do take that intermediate term low and we have a bigger retracement, we know, all right, it shouldn't take that high right there. But that high in the middle is not an intermediate term high. So the thing I'm trying to tell you here is that only once we take the intermediate term low right there, only then a new intermediate term high can form once we have a bigger retracement. So again, in between, from moving from that intermediate term high to that intermediate term low, short-term highs will form. Now, a short-term high is not just a swing high. Let me first go over one thing. When we have an intermediate term high, for example, this one, to now your intermediate term low, your new intermediate term low is that low, right? So we have this intermediate term high to that intermediate term low. This area right there, that is your intermediate term range, aka the range that should not fail. So in between that range is where you can potentially, if you want to, you can draw your premium and discount on. Then in between this intermediate term high and that intermediate term low, we now are forming, you guessed it, from a short-term high to a short-term low, we are forming short-term ranges. And a short-term range always needs to have a fair value gap in the range. So from that swing high right there to that swing low, do we have a fair value gap in that range lower? Yes, we have. So that is a short-term range, aka this high should get respected and should not get disrespected until we reach that intermediate term low we have at the bottom right there. Then after that, we also have this short-term range right there, that short-term high. So once we have that fair value gap in the leg, we have a confirmed short-term high, a confirmed short-term range as well. And the beautiful thing is, a short-term high usually forms at a previous premium array. So this short-term high forms at what? Fair value gap. Then this gets swept. Is it disrespecting that high? No, it's not. It's respecting that high because it's sweeping. It's not closing above it. It's respecting it. So it's sweeping that high. So this high, is it coming off of a premium array? Yes, it is. Does it have a fair value gap lower in the leg on this time frame on the 1 hour? It doesn't. Don't justify the fair value gaps by going down in time frames. When you need to justify something, you go up in time frames, never down in time frames, because otherwise everything can be justified. Then after that, what do we see? We have this short-term high because it now has a fair value gap lower. So this high should not get disrespected before when? Before we reach that intermediate term low. Then afterwards, all these highs, are they relevant? Yes, as liquidity, they could be relevant. But the only thing relevant is that we are not disrespecting that high with fair value gap in the leg lower. And then right here, what do we see? We have this high that is leaving behind a new fair value gap. That already, only that single fair value gap, that is already enough to tell you this is a new short-term high. And that one should not get broken. So this right there is your new short-term high. Then afterwards, we have a new short-term high, and then we reach the target right there. If you have been following along with the other videos, you know that we use a context always from an intermediate term high to an intermediate term low. In between that price action, that is where you want to get involved. Now, I'm going to give you a lot of golden nuggets, so please write them down. The ST model is based on trading the potential intermediate term high, because all you are doing with an ST model is trading the first fair value gap lower in this case, which once that happens is you are trying to catch the swing high that is getting formed right there inside that fair value gap, which then confirms the intermediate term high. So whenever I say a potential intermediate term high is in the making, that is what I mean. So the ST entry is the very early entry. You don't have to take that one. That one is riskier. The short-term ranges that follow afterwards, those are the highest probability trades that you can take. Imagine in this price action leg down right there, if you were to use the no daily bias strategy that was taught in the previous A to C episode, you would have a very profitable time, a great time. What you're not realizing is that you are trading, in fact, in the middle of a market maker model, because moving from this intermediate term high right there to that intermediate term low, that is your context. That is your market maker model. The only thing is, you don't need to know it's a market maker model. You don't need to know it's a power of 3. You don't need to know it's an AMD cycle. You don't need to know it's a smart money reversal. These are all concepts that don't need to be that difficult. There's literally no benefits of them being that difficult. Everything I'm going over here is all the concepts. You could name a concept, it is in the trading plan. The only thing you're doing is you're not paying attention to it. There's a major reason why we do that in the first place. And that is something we go over inside the money making team, inside the mentorship. It's not that we don't understand the concepts. It's that everyone here, understands the concepts at such a deep level that we are able to simplify it. Because again, every concept that you can think of is involved in this trading plan. And so we know the context, we know where a market maker model will likely form, but still a bit vague. Again, we are going to go over market maker model more in depth in an upcoming video. But there's 2 more things that I want to talk about here. So right here on the daily time frame on Australian dollar, US dollar, what are we seeing? In the weekly forecast, we mentioned lower prices with this being our draw on liquidity. Then right here, this is not the cleanest price action at the top right there, but this is again the same premise. We see this high, then we see this high. This is an official short-term high. Why? Because it now has a fair value gap in the leg lower. So this high is your last line of defense. So you know, based on Nasdaq as well, what we just saw is you know where to take a trade and you know where to likely place your stop loss if you can combine the timeframes correctly, which is what we're going to go over right now. Then we have a retracement, and right here, what do we see? A new short-term high because it is a new fair value gap lower. This high should not get disrespected. So we first had that high, afterwards that high, then now we have this high right there. Afterwards, we see another high, another swing high right there. Is that a short-term high? No, why not? It doesn't have a fair value gap lower. So this is your new short-term high right there because we have a fair value gap sitting right there. If we mark out that fair value gap right there and we go into the lower time frame, what we saw on the daily time frame were what? It were short-term highs and short-term ranges. What are we seeing on the 1 hour time frame? Intermediate term highs and intermediate term ranges. So it's important to understand that once we take out this intermediate term low right there on a 1 hour basis, that the retracement back into that range will 9 out of 10 times will retrace back into a PD array that is on the time frame above it. So remember, when I tell you the time frame you are trading on needs to be in context of the time frame above it, this is what I'm trying to tell you. Because if you don't see that and you see this fair value gap lower on a 1 hour time frame right there, you're getting blindsided by the fact that there's a daily fair value gap hovering just above your head. It's not a fancy turtle soup concept, it's just logic. So the intermediate term high that forms on the 1 hour will form at a premium array on the time frames above it. Then the same context that we have on the daily time frame where we move from daily premium array to that daily discount array is the same thing that we are seeing on the 1 hour. The only thing is you have the daily fair value gap right there. Then you have your intermediate term high to your intermediate term low right there. And in between that intermediate term high and that intermediate term low, that is where your short-term highs will form. And that is exactly where you want to get involved. And you don't need to use the 1 hour for a daily fair value gap. You can also go lower. That's exactly what I showed inside the trading plans. Then right here, what do we see? This ST right there, what are you doing? You are trading the potential intermediate term high that is in the making right there. The intermediate term high forms at what? It forms at a premium array on the time frame above it. So the 1 hour needs to be in context of the 4 hour. The 4 hour needs to be in context of the daily. Means 1 hour also needs to be in context of your daily automatically. So if there's a daily fair value gap right there, then the 1 hour intermediate term high will form at your daily fair value gap. Then once we trade into that and we have fair value gaps lower, we have an ST model right there. The ST model is trading the potential intermediate term high. this can be done successfully if you know how to combine the time frames. The second one is where we now are trading on lower. Then this is now a confirmed intermediate term high because we have a short-term high to the right of it. And it's a short-term high. Why? It's coming off of this premium array right there in the form of that breaker and the fair value gap. And the most important part, it has a fair value gap lower in the range right there. So everything after is even higher probability. And then you just follow the highs. You follow the highs. Keep on following the highs. And when we do have a deeper retracement, what do we retrace into? Something on the higher time frame. Right here, we saw that this was a short-term high on the 1 hour. It's not getting respect anymore. Why? It's retracing right now to that order block with that fair value gap as well. And what forms right there? Your 1 hour needs to be in context of your 4 hour. What is forming at that 4 hour premium array? A 1 hour intermediate term high. And this is your new 1 hour intermediate term high. And the same exact process happens over and over and over. Here we are back on NASDAQ. Because what did I just tell you at the beginning of the video? This is not an intermediate term high. Why not? Because when you look at it from a 1 hour perspective, it meets the criteria. Yes, it does. The first reason is we have a higher intermediate term high very close to it. That is not as objective. But if we now zoom out to the 4 hour time frame, what do we see? This is just a short-term high. This is your intermediate term high. This is your new intermediate term high. It's having the 1 hour in context of the 4 hour time frame. So whenever we sweep this high and that intermediate term high on the 1 hour, don't be surprised. Because right there on the lower time frame on the 1 hour, on the 15 minute, what's forming at that high? Even more intermediate term highs. It's combining the time frames. So all the components we just talked about. So you now know the context, you know when to trade, how you can get to entries as well, because you're just using short-term ranges for your entries and you target intermediate term highs or intermediate term lows. Remember the criteria for a short-term range. And now you know that if you can combine the timeframes correctly and you are aware of the timeframes, and I don't mean combining the timeframes as in you're using the 2 hour time frame, you're using the 3 hour time frame. No, just the 1 minute, 5 minute, 15 minute, 1 hour, 4 hour, daily, weekly, monthly. That's it. That's all you need. And now you know what it means when I say there's a potential intermediate term high in the making right there. You can also try to catch that intermediate term high, or you can try to catch the short-term ranges afterwards. And you know where intermediate term highs form. They form at PD arrays on the time frame above it, because the time frame you are trading on always needs to be in context of the time frame above it. Now you would be absolutely mind blown how we are able to use this inside the mentorship and how we have been able to stack up a lot of assets under management in a very small amount of time. You can visit either ario.io or you can scan the QR code that is on your screen right now. And then I'll see you at the weekly forecast on Sunday. Perfect. Thank you.